Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel, and today we have a very special guest in mobile home park operator Roger King, founder of Kings Unlimited LLC. Before we dive in, I want to ask you a real quick favor. Would you mind taking an extra 30 seconds and heading over to iTunes to rate this podcast with 5 stars? This helps us get more listeners, and it means the absolute world to me. So thanks for making my day with that review of the show. All right, let's dive in. Roger King oversees a diverse portfolio of real estate valued at over $50 million. His portfolio is located across 13 states around the United States, and he has a strong emphasis on mobile home communities scattered across 8 of those 13 states. Roger, excited to welcome you to the show.
Andrew, thank you so much for having me.
Yeah. Would you mind starting out by telling us a little about your story and how in the world you got into manufactured housing communities?
Sure. Well, like many investors, you start somewhere else. And I started as a musician and got out of music college, wanted to started investing in real estate because I saw the benefits to certain lifestyle attributes that I wanted to develop over my career. Started in Orlando, where you're based. And then I, moved to California, got involved in some real estate projects out there and some companies. And then when the crash hit, losing everything, I started my own company, wholesaling and then fixing and flipping and then private lending and, building some homes. And around 2015, I started to really see that the fix and flip market and, the luxury home market that I was, also focused on building homes, we were slowing down. Things were taking a lot longer. And I could see the writing on the wall. There's a recession about to hit any day now. What can I invest in next? What can I jump into that's also going to do better in a downturn in the economy? And obviously, mobile home parks. That became a major focus. It did take me a while to pivot, get my head around everything. But in 2018, I had some partners and we started, we bought our first park in April of 2018 outside of Oklahoma. And since then, we've bought 15 parks. We exited that first park last year. I don't think we did very well on it, but, we still profited $500,000 after 5 years.
Yeah.
So a solid base hit after, really sort of doing a lot of dumb things, right? And this is me, I'm an experienced investor. My other partners, they're experienced investors, and we still made just some stupid mistakes. But, it's part of the path, right?
It happens. Yeah. We've all, been there, and we're excited to kind of dig into those so we can learn from those mistakes. But tell us about your current living situation. You live in Puerto Rico, right? Yeah. And we were talking before we started recording here. Maybe you could just tell our listeners a little bit about, the why behind your living in Puerto Rico.
Well, the why is, I don't know if your viewers can see my screen behind me. And if not, we can insert some B-roll from my back patio. I live on the water. I grew up in the Sarasota area, Florida, a little south of Sarasota, near the water. And I always loved the water. But living in Southern California and Las Vegas for a few years, I really missed living near the water. And I have a bunch of friends that have moved down here. There's obviously some major tax advantages to living here. And I have the ocean right behind me, literally 40 feet from my back patio. And I realized that there's such a healing component to being this close to the water. My dog and I, Daisy, we go to the beach a couple times a week. And it's like the complete picture for me. I've always wanted to live on the water. I've got a bunch of friends that live here, and there's some major tax advantages. And in no particular order on any particular day, I would say they all sort of, jump back and forth with one another. but it's paradise. And
I love that.
I absolutely love it here. Yeah.
The lifestyle investor, right?
Yeah.
The lifestyle
Yeah.
investing and what
Right.
matters most, right? And I was just finishing Poor Charlie's Almanac with Charlie Munger. They just did like a new rendition of that. And he's talking about like, to prioritize like what your purpose is, right? The purpose is not to just have all this money, right? The purpose is to have time freedom, and be diligent about that. And I think I just love that. So I love that you're doing the same thing. Talk about those tax benefits, man. Everybody has this little trick up their sleeve. What's the tax benefits of living in Puerto Rico for real estate investors like yourself?
Well, yeah, I mean, so without going into the minutia, because there's a lot of different things, right? The overarching view of it is if you can create a company that manages and exports a service back into the United States or even Spain or Colombia, you can structure it so that that company gets paid from those various investments. And so my Puerto Rico LLC receives money from the investments that I've set up in the States. And as a manager, I have to manage those investments. And so that's my business that I've exported. And so that money comes into me, and that's my income, personal Roger King income. And that then is taxed at a certain rate. And if you make over $3 million a year taxable income, you pay 4%. What I sort of describe as state and federal. And if you make under $3 million, you're paying 2% state and federal. I mean, it's not technically state and federal, but that's the tax rate for all of your taxes. Now, there are other fees you have to pay throughout the year. You have to donate some money to local charities. I believe that's $10,000 a year. Some of the prices are higher here. I bought a Jeep because I thought having a really high tire when it floods during the hurricanes, that it would, buy a Jeep. I don't need to have a luxury car. There's a lot of potholes. I've had a few luxury cars and, dinged them up pretty bad on potholes. So I thought a Jeep, where I normally would pay $39,000 in the States, I paid about $62,000 for it. So there's an import tax that does impact, your actual bottom dollar, your bottom line. But to me, if I'm paying, 2% on my state and federal, I think I'm doing great. I wonder how long it's going to take me to pay off my, my condo here. There's no capital gains tax. A lot of the crypto crowd, they moved down here and reorganized everything so that their assets were here in Puerto Rico. Then they would sell those assets, just get liquid on some of their crypto holdings. And that was capital gain tax free.
Wow.
So sometimes there's some property tax incentives. If you buy a property here, one place I looked at, there was no property tax for 5 years. Wow. So there's a lot of benefit. And then again, there's the sun and, the moon. And I've never taken this many photos of sunsets before. I'm amazed. But, you talk about that lifestyle, and hey, it's taken me a long time to get here. I just turned 56 a month ago, and I've been here for about a year and a half. So 55, it's doable. It's not always immediate. Right. Sure. But that was always a focus of mine, is how can I live because of my real estate investing? And mobile home parks have definitely helped in that regard.
Let's circle back and talk mobile home parks. 15 mobile home parks. Your first one is outside of Oklahoma. What in the beginning got you interested? How'd you get educated on mobile home parks, as an asset class?
I definitely talked to a lot of people, certainly in Southern California, where I was living at the time. I talked to some people down in the San Diego real estate investor clubs. There's I'm drawing a blank. Joe, I haven't talked to him in years. Joe was talking with me for, a bunch of different times about how he'd bought into a bunch of mobile home communities and how great they were. And I thought that's, someday that's where I'm going to get into, because I think it's a really great asset class for the revenue that's generated when the economy tanks. I think that these parks can fill up faster than an apartment complex. Historically speaking, they have. Historically speaking, they've done better than multifamily. And I know that a lot of what I had gone through was just really understanding the business model. And then I knew with my history and with the right partners that we could jump in, collectively figure it all out. Maybe not as fast as or as sharp as we were thinking we were, but we knew that we could figure it out whatever happened. And we did, obviously. I think it was a really good first park. I don't know that I would buy something so far away from the city center. We learned that the MSA was a critical factor when you're looking, even doing due diligence. How far away is it from a major metropolitan, an MSA, a minor metropolitan area, and figuring out those parameters was really helpful prior to going into it.
Yeah. What would you say, Roger, are those parameters? Like, obviously, purchasing one near an MSA, but is there how do you know a good MSA versus a not good MSA? Or was this park outside of Oklahoma, kind of very rural, kind of out in the middle of nowhere?
It was. And it's not a bad place by any stretch. It's just the amount of people looking for a place to live was so constricted because of the distance from Oklahoma City.
Okay.
So I had to, that was one of our big problems. We bought it. I think that
how far away
these are the numbers
from OKC, if you remember, how far of a drive would it be away?
90 minutes.
Oh, 90 minutes. Okay. Gotcha.
Yeah. Yeah. And again, a nice little town, but we didn't have the turnover. If somebody moved out, it would take weeks, if not months, to rent that same unit. And we bought the park with, I think it was 142 spaces, and only half of the spaces were full. So we were thinking, hey, we're just going to manage it better, and we're going to fill in those other 70 spaces or whatever.
Sure.
And we're going to quadruple our blah blah blah, and and it just didn't happen, all because of our distance from Oklahoma City. There just wasn't enough influx of potential tenants.
Gotcha. No, that makes a lot of sense. Thank you for sharing that with us.
Huge mistake. Yeah.
Tell us, what other hurdles or what do you think is the toughest hurdle to overcome in mobile home park investing?
The toughest hurdle, I would say right now, and I believe it's changed, I would say if you're buying a park and your intention is to fix it up, reposition it, like the majority of our work is, contractors right now, pricing materials is just, when we first started, we were buying new homes for $28,000. And that same home now I think is 45, maybe 48,000. And how do you tweak that budget? So the margins have gotten a lot smaller, but I'd say if you're hiring contractors, finding the right people is a really difficult process right now. That may change, but I don't see it changing as in the way we need it to, or certainly not as fast as we need it to. And I'd say the other thing is, if your plan is to sell the homes to an end user and you have a tenant-owned home and you're just collecting the lot rent, getting them qualified has been more difficult. So then there becomes a kind of a seller financing aspect to how do you hold it? So if you spend 25 or 30,000 to fix it up, and you can only get 2 or 3 or 4,000 as a deposit down payment, then you're still upside down with some of your cash. So that's something to really consider.
That's a really good point. I don't think this is talked about enough. Is the CapEx, right? It's a CapEx intensive business. We own some self-storage facilities, and it's very minimal CapEx, right? The buildings are there. It's just, metal, sheet metal, buildings.
Yeah.
But, we were looking at our KPI dashboard, and on some of our communities this month, they cash flowed $8,000, but we had 20 grand in CapEx, because a wholesaler came in and was trying to buy this home from one of our tenants that was selling. So then we had to come in and buy that home from the tenant before the wholesaler, bought it and moved it out. So, we'll recoup that. But like you're saying, we spent 20 grand cash to buy that home, and now we're going to sell it, but not for 20 grand cash, right? It'll be some sort of like rent to own type of arrangement. So I think that's not talked about enough. So thank you for touching on that. That's important.
Sure. Yeah. I mean, if you're in it, you know it. My business partner, Brandon, he talks to a lot of other people about it that are, CEOs of people that own companies that own, 4,000, spaces, and they're all dealing with the same stuff. How do you rent it out? Getting it marketed. Facebook marketplaces are really challenging area to, post a vacant home for rent or for sale, because they don't want you to do it for some reason. I mean, it's just it's the
scalability of it. And that's another great point.
Right.
If you can't have one person posting 12 homes in 12 different states on Facebook Marketplace, or your account gets flagged and they shut you down.
Yeah.
So you gotta, what we did is we have our on-site managers, do the postings, but then you're dependent upon them to respond to people in a timely fashion, to actually attend the showings. So you bring up some really good points, Roger. I agree. Those are some hurdles.
Thanks.
Let's talk about the last few years. Rates are high. How have you guys pivoted around interest rates being higher, and have you been able to buy some new acquisitions?
Oh, yeah. I think we were fortunate enough to have built some relationship with our lenders, so they knew, our ability to execute, to turn the projects around. And I think that that's an important part of it. I would also say, it's not been an easy road these last 2 years with lenders. We had a lender that we were working on refinancing for 8 months, and then they said, hey, you were about 3 weeks away, and they took it back to their board, and the board said, we're not lending anything anymore.
Oh my goodness.
Yeah, and so start the process over. We had bought some owner financing properties that way. And so the sellers were like, hey, you had 3 years to get this thing refinanced. And we're like, look, we've been trying. So some unhappy moments there, some stressful moments, some frustrating moments. It's like, guys, look, if your board is even remotely thinking that you're not going to be lending, please give us notice.
Please. Yeah.
Just, common courtesy. So I think that the pivot really has been more not into buying or reflecting on, operations per se. I think it's been, a mental thing where we just have to get more resilient. We have to realize that it's not going to go as fast as the lender's telling us. And they're going to ask for an Alta survey the last week before you're supposed to close, even though you've got 15 emails from the last 4 months saying, no, we don't need an Alta survey.
Yeah.
Right.
Jeez.
So I think that resilience and just being prepared for the unexpected is a really critical emotional tool that we have to develop. And I think we've really, Brandon and I talk about it. How do we see the world right now? It's just things are challenging. So that's not going away. We have to get stronger. And I would urge,
and how you guys,
anybody.
Yeah. How would you say specifically you guys did that on the last 2 acquisitions? Like, have you bought anything in the last year?
Yeah, we bought something. I think we closed the day before Thanksgiving over in Chicago. And that's the example of the Alta survey. We got very frustrated, both at the seller and at the lender. And guys, you can't just keep stacking these things on or twisting what you'd agreed to. So I think it's just, there's a bit of a callus that gets developed initially.
And Roger, I guess like my question is more about like the dynamics of the deal, the numbers on the deal, if your interest rate is 8.5% on the debt, are you getting the seller to hold a second note, or are these seller finance deals, or, are these value add deals? How are you getting deals to pencil out with rates being so high?
Yeah, I think that's more a factor of, we have to find a shorter term loan that will recast in a few years. So it may be an interest only period. And they're going to want to hold some capital back. So we may need to deposit. We've had to deposit capital with the bank so that they could do a draw payment to us so that they could feel more comfortable. And again, that's kind of a last minute thing that they sprung on us. So we just realized, there's nothing we can really do in this climate when rates are that high. We're just going to have to suck it up. In terms of our diligence, I think on our first park, we had an offer for $3.7 million. And we'd bought it for 1.5 4 years before. And Brandon and I were like, you know what? Let's wait till it gets to 400 or to 4 million, then we'll sell it. And I realized, gosh, we got our greed glands going because we ended up selling it for 2.5. And had we taken that offer for 3.7, it's a different world. It's a different project. But I would say adjusting during your due diligence phase, adjusting your targets. If you reach a target and one of those targets is, I want to exit this so I can take it and, 1031 it into another property, let's really evaluate if we hit the target, do we stay or can we continue to improve it?
Sure.
And I think we missed the ball. So that's part of it too.
I'm sure a lot of sellers feel that exact same way, right? Like,
sure.
Back in 2021, 2022, it was the prime time, right? That was the peak. And, we were selling some self-storage and it was the same thing. We kind of missed that peak by a year. But tell me, Roger, what is your mobile home park investing strategy and maybe how has it changed from that first deal outside of Oklahoma City? Are you buying deep value add, 50% vacant projects? Are you buying more stabilized stuff? You buying anything you can get your hands on? What does that strategy look like and why?
Yeah, it was the buy the 50% and just try to do everything. And the first park, we did that. The second park, it was probably 65% occupied. And that has actually turned out to be probably our best park so far that we bought 6 months later in Kentucky. And we've bought a bunch of the small ones, the 10 or 15, and those just become too management intensive. And when you can't find a good manager, it becomes a really thorny situation. So we've, continued to reassess, how are we buying these things? And we no longer want to buy those properties that need a heavy lift. We don't want to spend our time doing that anymore. We want to have 70%. We actually last year, Brandon and I went through this whole process of what do we want to do next, right? What is our criteria next? And we wrote it all down and we've like, okay, does this park fall into our criteria? Yes, except for this. Okay, so why spend our time? It doesn't make sense anymore. So I think we're getting much more discerning with that experience, with those experiences. We've got a good park. We've had a not so good park. We've had some small parks. We've had some big parks. And so through our own trial and error and our experiences and our self-evaluation, I'd say that we've become more discerning on, do we want this particular thing? And what does it look like to get out? Because both Brandon and I love the idea of holding these things forever, but it may not make economical sense if somebody's offering us 2.5 times more than what we paid, because the market's crushing it.
Yeah, because what is it going to take? 15 years in cash flow to hit the proceeds that you could get, now to sell. It's a good exercise to go through. Hey, how many years of cash flow is this if I sold today?
Right.
That's a game changer. So that's interesting.
It is a game changer. Yeah.
What is that deal criteria for you guys right now? Is it?
Oh man, I haven't looked at that list, but let's do this. Let's put it in the show notes.
Okay. Yeah, we could do that.
Is that okay?
Put the deal criteria in the show notes. Like ours is above 50 lots, public utilities, within 40 minutes of an MSA. That has at least 50,000. And, we like what kind of you circled on is like something around 60%. It has to be at least 60% occupied, so it's cash flowing day one.
Yes.
So any listeners out there, if you find a deal like that, Send it to me before you send it to Roger, okay?
Or send it to us.
Send it to both of us. Yeah, exactly.
I mean, why not?
Totally.
So I think that, and I know that a lot of your listeners are passive investors in this, or wanting to be passive investors. And I would say that if you're looking at mobile home parks as an investment vehicle for, you're a doctor or whatever, and your 401k or your, self-directed IRA wants to participate in this, I think that you need to partner with people that have already gone through a bunch of these growing pains. Because there's a lot of people that have been around for a year and a half and they look really great on camera, but they haven't gone through some of the challenges that a lot of these longer term investors have. I started in 1996 as a real estate investor. I know, Andrew, you've been around for a long time as well. I don't even know how long. How long has it been?
Yeah, since 2011 is when I got into like single family stuff, but mobile home parks was 2016.
Yeah, so even longer than me. And I honor that. And I think that alone really helps an investor know that while nothing is guaranteed, it mitigates the risks that are inherent in every investment. And I think it's super critical. So I honor your time and your
this is
your
completely
pain
random.
suffered.
Yeah, this is completely random. But my wife and I just started watching this NASCAR show, right? And there's this guy named Denny Hamlin, and he's pretty good, right?
Yeah.
But he was in the front at this race. I forget where it was, but he was in the very front, and things were getting choppy up there, right? Like, he's a veteran guy. He's got like I want to say he's got over 50 wins, right? And he was in the very front, and he knew that, like, for the NASCAR series, that like he couldn't crash. He needed the points by finishing. So he literally went to the side, went all the way to the back, and a little while later, big crash happened. So it's like that spidey sense to know, hey, this guy has experience. He knows when things are choppy up there. To know to get out, I think that is what you're pointing at here. Experience matters. Yeah. If you've been in a lot of deals, you've been in a lot of parks, you'll know when to sell one, because you just get a spidey sense that something's off here. The people that we're getting that are applying are not the quality we're hoping for. There's just a variety of, that we're not getting enough leads off of our marketing. Something's going on here. It's probably a good time to kind of come to the back and let things settle. So that was a good point there. What else, if you were going to invest passively into a mobile home park investment fund or a syndication, what else would you want to know? Like, what matters most as a passive investor?
What a great question. I think aside, next, if the experience is one aspect of the general partners, I think a limited partner, if we're talking about a syndication, has to understand what the ethics are of that general partner. Is this the kind of guy that is, or gal, that's going to not do what they have to do to take care of you? Your money is on the line. And somebody's degree of ethics is such a criteria for me that if there's a hint, through a conversation or, obviously Google searches, background searches, which are all things that everybody needs to be, participating in, man, if there's a hint, and if that can't be explained, and if there is some weird spidey sense in in your gut when you're talking to this person, just walk away, because I think you're listening to the right thing when you walk away, because there's something amiss. You want to obviously verify if any of these things are true, because the internet sucks in large part. But I think that the ethics are hypercritical for anybody's decision making when they're looking at, because they could have all the experience, but if they don't care about you and your 100,000 or 200,000, man, you're
in trouble.
Bad news, potentially, right?
Totally.
So I think that that's a really important thing for passive investors to really figure out.
Yeah.
Which, by the way, if you're going through that process and, the word passive investor, I don't think when you're going through due diligence that that's passive at all. I think that's your participation, and it may be limited to just those types of things when you're about to invest. I don't think that that's a passive investor, right?
Sure.
And it's not that I have a problem with the word passive investor, but I want people to understand that passive investing isn't fully passive. It isn't just, I hope, here's my money, good luck. It's, am I making the right decisions? Am I making the right choices by asking the right questions?
Yeah, there's a responsibility there to do your due diligence ahead of time, just like we do before we buy a park, to make sure, hey, am I getting what I think I'm getting out of this? So that's a great point. Roger, what mistakes in mobile home park investing have you made that we could learn from? I mean, you mentioned, buying too far away from an MSA. If you had to put together 2 or 3 more, just real quick, bite-sized mistakes that we could walk away with, what would those be?
Sure. Sewer lagoons. Don't buy a park with a sewer lagoon. Unless, of course, you have it budgeted that you're going to tie into the city, sewer and water. I would say if you're joint venturing with somebody, you want to make sure that your roles and responsibilities are already lined up. And if there's a problem and somebody isn't meeting those responsibilities, what action can be taken on behalf of you or the other partners? I think that that is critical. I would say that having a property manager that is really overseen for the first 6 months, like hard, not hard in the approach to them, but just really following up and making sure that, look, your responsibility is to rent or sell these. And if that's not the top of your list because you're too busy with other things like, street cleaning, then you're the wrong person. I need to have income. So that, the specifics for the manager has to get ironed out, day -10, right? 10 days prior to closing on the park. I would say that's it for now.
No, those are great. Yeah. Thank you for sharing those with us. I think those are awesome. I would have to say, just to piggyback on that the on-site manager can make or break a deal. Like if you have a good on-site manager, it literally will be 50% less headaches, because they will, just think about solutions instead of just, throwing problems your way. So that's a big one. Roger, what does the perfect mobile home park look like in your eyes, and why?
Oh, it's I bought it in 1994. And they're all brand new units, and it's 500 spaces, and it's got a spa, and it's in a wealthy area in Malibu.
Perfect. Yeah. That's good. Would it be on city utilities?
Absolutely.
Utilities?
Yeah, for sure. Yeah, city utilities, right? Because it just reduces your costs. Yeah, so that's where I would like.
Cool. What does the future of mobile home park investing look like? Obviously rates are high right now. What do you think's coming in the next 12 to 24 months?
Yeah, I think that the prices are going to start to increase because the interest rates are going to drop. I don't think it's going to happen this quarter, and I don't think it's going to be a significant drop or drops this year. Maybe a full point by the end of the year, probably 3/4. Seems reasonable. They're trying to do the soft landing thing. So if they did a 3/4 drop, man, that's going to explode the prices. Yeah. So what does that mean? That means that people that are sitting in cash right now have a really great opportunity to find the right operator. And if they're not the operator, if they're, like your listeners are looking for the right operator, looking for the right areas, maybe they want to have it within an hour or 2 hour drive from where they live, so they feel they can, just drive by on some, once a quarter or whatever. Some of my investors like to know that they can do that, and obviously you have to put ground rules on that process.
Sure.
But I would say, look, find out what's most important to you in a mobile home park. Mobile home communities are changing. So find out what's most important. You need to have mostly, 6% preferred return and 8% preferred return? What's your targeted, IRR? What's your exit strategy? How many times have your general partners done this? Those are all the criteria and more, obviously, that you want to start pondering by asking yourself, what's most important? Okay, what else is most important? Okay, if I could have my favorite park, what would it be?
Yeah.
Right. So those are the things that I would say, get ready to start investing in some properties, because there's stuff that's going to happen pretty soon.
Yeah. And there's sellers, like, this is something I tell my acquisitions team all the time. You're just a day away from getting a phone call. Like, people say they don't want to sell, but then life happens, right? Life events happen, and then things become more urgent. And I think, like my strategy is a long-term, compounding benefit, right? I'm going to own these things 20, 30 years. And I think if you have that model, looking at the next 12 to 24 months and saying, oh, we're pencils down, we can't get deals to pencil out, it's too short term. If you're looking to buy something, fix it up and flip it, maybe that's, not a good time. But for a long-term approach, interest rates really, they're going to go up, they're going to go down. Like it's going to happen. So just expecting that, and over the long term, you're going to be just fine. So that was good.
Look, you talk about high interest rates. My father started investing in 1980 in that town, Englewood, Florida, and interest rates were 16 and 18% in 1980. And he still invested, thousands and tens of thousands of investors still made money on those properties they were buying at 18%. So if the strategy is 10, 20, 30-year holds, whatever, you're not going to stay in the loan that long.
Exactly. Yeah.
You're going to stay in the property. Massive mind shift for a lot of people.
Huge mind shift right there. That's huge. Yeah. What's the biggest threat? If we're playing devil's advocate here, what's the biggest threat to mobile home park investing right now?
Insurance costs. They're just astronomically bad and getting worse in certain communities, certain states, because, California, they're leaving. The major name carriers are taking off. Florida, same thing. Last year, I saw a bunch of exits from the state from, was it carriers and just all the name insurers are leaving because they just don't want to pay out. The ones that are staying, the smaller carriers that, may not pay out on your, $2 million claim if a tornado or hurricane hits, they're just going to charge astronomical amounts more than what you've pro forma'd. Astronomical. So how do you take a park where it's been paying $11,000 a year and suddenly you wake up with a bill for $45,000? Because it's happened. It happens every day right now. And it's tough to make those things work. I think that's a major problem.
That is a major problem. Yeah, we don't own any in Florida, but we have looked, and that's just such an interesting dynamic. I know a lot of multifamily, apartment complexes have seen astronomical increases in their insurance costs. But from a mobile home park perspective, I mean, if you're not insuring the homes themselves and you don't have a lot of buildings, what is causing the pricing to increase so much, on your policies?
Well, what's causing it, I would say greed more than anything, because they can. If an insurance company says, hey, we want to triple our premium, okay.
They can. Yeah.
They can.
That's interesting. Yeah. We haven't seen that, in the policies that we own. There hasn't been like an astronomical increase because, again, there's not a lot of property that we're insuring. We're not insuring buildings and apartments and, things like that. We're just insuring the infrastructure, the utility infrastructure. And that's, So anyways, thanks for sharing that.
Yeah.
Roger, this has been an awesome talk. I'm just super grateful that you took time away from the beautiful Puerto Rico beach in the background to hang out with me and hang out with all the listeners here. If any of our listeners would like to get a hold of you, what would be the best way for them to do so, Roger?
Yeah, go to my website, rogerking.com, and sign up for my newsletter. I send out a newsletter every Thursday, and it's the REI Evolution newsletter. And really, it's designed for investors who want to just understand what's going on. They want to understand the different factors of, property. They want to understand tax implications. They want to understand wealth growth. Just a whole host of things every week, and it's all curated. And I think that I'm really excited. We just actually launched it last week, so episode 2 comes out today, or edition 2. I don't even know what I'm calling it. So rogerking.com is the best way. And you can find me on all of the social media handles, of course, which I think you'll probably put in the show notes.
Show notes. Yep.
Yeah.
We'll make sure to do that.
Awesome. Thank you. Andrew, It's been a pleasure for me. Like, great questions. And I love the focus on the mobile home parks and the passive investor. So thanks for inviting me into the community.
Totally. To piggyback on that, if you had one last bit of information, one last bit of important advice that you would give an interested passive investor before we sign off, what would that be?
You have to get into this particular sector. I think it is a high growth sector over the next couple of decades. Affordable housing is not going anywhere. It is, except up in terms of growth. We have to have homes for people that can't afford, the $3,000 a month apartment building, or apartment unit. So $700 to $1,000 unit, I think that's a sweet spot for a lot of people in our country. And so figure out how to do it and get it done.
I love that so much. I was at the gym a couple of days ago, and there was a guy getting out of his car, and it was like a gorgeous Rolls Royce. I mean, like the fanciest Rolls Royce I've ever seen. And it was an older gentleman. And I said, hey, sir, sorry to bother you, but what should I be doing to be able to buy one of these someday?
Yeah.
And he thinks a second, and he looks back at me and he goes, take lots of chances, kid. And he gives me like a salute, and he walks off. And it was just like exactly what you were just saying. You got to jump in. You got to take a chance. You got to get in a deal, right? Even if you're a passive investor investing and you're just putting money in with another investor, you'll learn so much, and you'll get your foot in the door instead of waiting and having that analysis paralysis where you're just, I'm going to wait and buy my own park. I'm going to do it. I'm going to do it. And it's 2-3 years later and you still don't have a deal. Jump in with an operator that you like and trust, and take the risk. So I love that, Roger. Thank you for sharing.
Yeah, right back at you. Right back at you. Thank you, Andrew. I appreciate it.
Well, that's it for today, folks. Remember, please leave a review if you got any value out of this show, wherever you listen to your podcast at. And thanks again for tuning in. Would you like to see mobile home park value add projects in progress? If so, follow us on Instagram at Passive MHP Investing for photos and awesome videos from our recent mobile home park acquisitions. Once again, that's at Passive MHP Investing on Instagram. See you there.